In this video, I'm going to talk you through the 5 key principles which will make you a good trader, and that is time, price, direction, risk management, and trading psychology. So time is trading at the right time of day when the market makes its big move rather than when you feel like it or just at random times. Price is the price points where you're buying and selling. It's your price action and it's your key levels. Direction, we all understand as up, down, or sideways. This is a very important part of successful trading. Risk management is so important. It's believed that an inexperienced trader with good risk management could outperform an experienced trader with poor risk management. And trading psychology is the final element which ties it all together. This is how to not let fear or greed interfere with your decision making when you're trading. So if you're excited to hear more about these 5 key principles, make sure to give the thumbs up button a little hit before we get started. And if you want to see more content like this, make sure to subscribe to Thinkmarkets now as well. So the first key principle is time. This means trading at the time of day when the market you trade actually moves and has volume in it. This is the US 30. This is the market that I trade. And can you see how in this section here, this is the London section, it's got tiny little candles and it's moving sideways. So trading in this time wouldn't really get you very far. When New York opens, the market starts to have a lot of volume in it and it starts to make its big move. So this you can see here is when New York is open. This is a nicer time of day to trade the US indices. But a lot of traders, when they first start trading, will actually just trade at random times or when they feel like it, rather than specifically and intentionally trading at the times of day when the market that they're trading moves at. So first of all, you want to figure out what market you're trading and what time of day it moves at, and be really focused on trading on those times. But also, there are days of the week when the market doesn't have volume in it. Often this can be days before big news events or after a really big unexpected piece of news. These are also days to avoid, so timing also includes that. It can also include your exact entry and your exit. So obviously you could get the direction right, but if your entry and your exit, if your timing is wrong, you will still lose money. Can you see how the market made this nice big move up here? But imagine if you entered at this point, and then the market makes a pullback and it hits your stop loss. You got the direction right, but your timing was wrong. So timing is a really important element of trading, and that is why I included it first. The next key element is price. So can you see along the side here, we have the price. These are the price points where you buy and sell at. Along the bottom, we have time. So these candlesticks are a visual representation of how the price moves over a certain period of time. So the patterns and the shapes that they throw out, we read that as price action. And understanding price action is really important to trading because it can give you so many clues about what the market is doing and what it's likely to do next. Price includes key levels. So these are horizontal lines which you will draw onto the chart at certain points. And I go into this in a lot of detail in other videos on Thinkmarkets YouTube channel. So if you want to know the exact price points, the exact key levels for the US 30 that you can draw on, then a next step after watching this video is to watch one of those ones to learn more about key levels. But you draw them on, the levels represent certain price points that you would buy and sell from. The next key element is direction. So we've ultimately got 3 directions, and that is up, down, or sideways. We can see all 3 of those as an example on the chart right now. So here in the London section, you can see that the market is moving sideways. This is when we are not that interested in trading. As New York opens, we can see the market made a big push down, and then it made a big move up. This is a very common pattern in trading. You often get that consolidation before the session. You sometimes get a false move in the opposite direction, and then you get the main move of the day. Understanding how the price moves, how it's likely to move, and what direction it's moving in is a really key part of trading. I also like to go to the day chart as well, because often the day chart can give you clues on direction that you don't necessarily get on the small time frame. So you want to be looking at the long-term direction as well, even when you are trading on smaller time frames. Direction is very, very key element in trading well. The next key element is risk management. So let's go back to the 1 minute chart and I'm going to show you how we look at risk management. So one of the points in risk management is to make sure that you have a risk to reward ratio that's in your favor. So for example, if your stop loss was around 30 points and your risk was 120, that would mean you have a risk to reward ratio of 1 to 4. Let me just show you here. So let's say you take a buy position here, you risk 30 points. That means that if your stop loss gets hit, you will lose 30 points and you have a reward of 120. Let's just click in here and we can do it the easy way. 120 there. So we'll do 30 and 120. Can you see here, you've got a risk to reward ratio of 4. That means that for every dollar that you risk, you can potentially get another dollar in return. So this is part of good risk management because you always want to be keeping your risk as small as possible. And you want every trade to have the potential to win you more than you are risking at any one time. That means that when you look at your profit and loss, you should see lots of small losses and some really big wins. And the big wins should override the losses. This is also incorporated in strike rate. So say your strike rate is 50%. Say for every trade you win, you also lose one. If your risk to reward ratio is 1 to 4, that means that for every 30 points you lose, you make 120, which means that for every 2 trades you take, effectively, you're making 90 points. So it's really important to keep on top of the risk to reward ratio and make sure it's in your favor. And the 5th key element is trading psychology. So the 2 main emotions that traders seem to struggle with is fear and greed. So fear can mean interfering with the trade. So when the trade is open, closing it too soon and actually not making as much as you could do because you are afraid. It can mean selling too quickly. And then there's greed, which can mean holding your trades for too long and almost expecting something unrealistic out of the market and making decisions based on greed. What you should be focusing on when you're a trader is trading well rather than making money. So I would always say to watch the position tool on Think Trader rather than to watch the money amount on your phone. So rather than looking at the app or looking at the money amount wherever you're trading, you want to be looking at the trade actually playing out so that you're focused on trading well rather than making decisions based on the money amount. So I hope you found this video helpful. If you did, make sure to give it a little thumbs up. I've recently made a video on Thinkmarkets YouTube channel going over 4 trading psychology hacks. So if you're interested in deepening your trading psychology, then make sure to watch that video next. And if you want to see more content like this, make sure to subscribe to Thinkmarkets now as well.